Hi, this is Sadiq Adesha, Chief Investment Officer for Sun Life Global Investments. As we begin to settle into a new normal, the markets are still showing signs of heightened uncertainty. In March, we saw the CBOE Volatility Index go above 80, which is quite extreme. Lately, it has been in the 30s and 40s, but that is still double the long-term average. As we move into the next phases of the pandemic, we continue to manage risk while looking for opportunities for the longer term. Join us as we present part 2 of our Quick Take series. At Sun Life Global Investments, we go through a rigorous process to select and monitor sub-advisors from around the world. In our Quick Takes conversations, these sub-advisors provide important insights into their regions or asset classes. We hope that this diverse coverage will help you manage and stay informed through this period.
Hello, thank you for joining us today as we speak with Head of Emerging Market Fixed Income, Sergei Strigo from Amundi Asset Management to discuss the Sun Life XL High Income Fund. Sergei, do you believe the recovery for emerging markets may be different than that of their developed market counterparts?
Thank you for your question. We think that the recovery of emerging market economies will follow a very similar path to that of the developed countries, and it will depend on several factors. Firstly, the speed at which these economies can go back to normal, to reopen again following the crisis. We obviously have a number of countries that are already opening up in emerging markets, for example, China, South Korea, and some others. Other countries, however, are still not doing that, so we need to watch over the next few weeks the development of the virus in major emerging market economies. Second point is on the unprecedented fiscal and monetary policy stimulus unleashed by the vast majority of the governments and the central banks in emerging market countries. That clearly will help the recovery effort in the emerging economies. I think what is very important to keep in mind as well is that we do have multilateral institutions such as the IMF, the World Bank, and the others that have also come forward with additional help to various emerging market economies, and we started to see this money being disbursed to emerging market countries to help fight this COVID-19 crisis. And the third point is clearly commodity prices. The recovery of these economies will depend on the path of commodity prices going forward, especially oil. What is encouraging to see is that following the OPEC plus countries' policy action to curb the supply, we've seen oil prices recovering somewhat to over $30 a barrel in Brent, and we think that there is more room for these prices to go somewhat higher.
Has COVID-19 changed the attractiveness of the opportunity in the emerging market debt asset class?
I think the attractiveness of emerging market bonds is still there. First of all, we have to remember that this has always been a yield enhancement opportunity and diversification from the conventional developed market bonds in investors' portfolio. Current level of yields in emerging market fixed income, in my view, are attractive, and keep in mind that we are in an environment of very low yields in the developed world, including Canada, and these low level of yields probably are going to stay there for a very, very long time. So any opportunity to enhance that yield, to invest in bonds which are safe but provide investors with yield pickup is definitely interesting. Second point on this is the repricing. The recent repricing of the asset class clearly has been very, very significant. Credit spreads in government bonds in emerging market countries have practically doubled since the levels of February. So it gives investors interesting entry point to the market in the current environment.
Have there been any changes to the fund?
In regarding the portfolio, we have not really changed our global asset allocation view. We had a pretty defensive view going into this crisis, and between three asset classes that this fund invests in, namely US dollar denominated bonds, local currency bonds, and emerging market currencies, between the three asset classes, we still favor US dollar denominated bonds. We think this is the safest asset class. Credit spreads are currently attractive. You have no currency risk investing in this asset class. So we remain overweight in the portfolio on this asset class. On the local currency side, we do favor countries where central banks are actively cutting interest rates, where real rates are high. So to name a few countries like Russia, countries like Indonesia, for example, definitely we see value in local currency rates, but it is more a country-by-country view. And finally, on the FX, we do not necessarily like FX risk at this stage. We think that emerging market currencies can still weaken further against the dollar because this is one of the very few mechanisms that these countries can use to help rebalance the economy. So we remain very much cautious and in some cases underweight on the emerging market FX in our portfolio.